is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Past the peak, U.S. inflation cools more than expected, fueling optimism that the Fed has room to slow the pace of rate hikes. China turbocharges the rally. Beijing eases quarantine rules, propelling markets higher, while European stocks start the day higher as well. Plus, crypto crisis. FTX founder Sam Bankman-Fried is set to face an SEC probe amid ongoing mayhem. We'll have plenty more from our interview with Tron's Justin Sun this hour. Now, first thing is first, happy Friday. Now let's check in on the markets. Now, the rally that started quite aggressively with a lot of conviction in the U.S. is definitely continuing in today's trading session. You can see technology getting some 2.4%, European stocks 0.7% higher. Do not really look at treasuries because they are closed. Two things to watch out for. I don't know whether we have the close from the U.S. yesterday, but definitely the NASDAQ, remember, was gaining some 7.2%, actually 7.5%. This was the biggest one-day gain since March 2020. And then the Dow Jones Industrial Average within reach of a big milestone, bull market, as stocks surge in a buy everything relief rally. The question is, how long does it last? Let's look at what the European markets are doing, maybe country by country, if we have the map, just to give us a good indication of what's going on. Remember, treasuries in the U.S. are actually closed today because of Veterans Day. The U.K., you can see the FTSE getting some 0.2%, but the more rally, the buy everything rally is continuing, certainly for the CAC 40 gaining 1.2%, as is for the FTSE MIB in Italy. Now, global stocks extending gains. That's as the loosening of China's COVID rules boosts a rally that began on Wall Street, following cooler than expected CPI. Bets for another jumbo hike have really paired with several Fed officials backing a downshift.
While I believe it may be appropriate to slow the pace of rate increases so we can better assess how financial and economic conditions are evolving, I also believe a slower pace should not be taken to represent easier policy.
In the upcoming months, in light of the cumulative tightening we have achieved, I expect we will slow the pace of our rate hikes as we approach a sufficiently restrictive stance. But I want to be clear, a rate hike of 50 basis points would still be significant.
Stepping down is an appropriate thing to think about. It is not to be confused with adjusting the terminal rate. By terminal, I don't mean the end rate we'll ever have. I mean the rate at which we would raise to hold.
A more measured approach to rate increases might be particularly useful as policymakers judge the economy's response to higher rates. Already, we've seen the committee's policy actions lead to a very sharp tightening of financial conditions.
Well, joining us now is Patrick Armstrong. He's Plurimi Wealth Chief Investment Officer. Patrick, I've been waiting to speak to you all week. What happens, actually, after the rally we had yesterday? We did lose quite a lot of money on the stock markets the day before and the day before that. So are we going to see this whipsawing event until, for the next 6 months?
I think it's a bit of a sigh of relief. I was expecting the Fed to hike 50 basis points in December. I still expect them to hike 50 basis points in December. But in the back of my mind, and I think in the back of a lot of investors' minds, a hot print could force them to do another 75. And I think that's been taken off the table. Powell's press conference, all the Fed speakers yesterday indicated a slower pace of hikes is coming. And with core CPI coming in at 0.3% month on month, 0.5 was the expectation. So that was a big miss, if you want to call it a miss. Anyway, inflation wasn't as high as people expected or as people worried. So it set the stage where duration rallied yesterday. I'm still short duration in stocks. I still think when you've got a 4% 10-year yield and credit risk, those are rates that will punish no earnings tech. And those kind of companies were up 10% yesterday. But the companies I love in equities are the companies that have defendable profit margins. And they're all up quite a bit too. So luxury companies, I think higher input prices are still going to happen. But companies with defendable margins, I think, are really positioned well right now.
So, Patrick, does that mean you're a little bit skeptic about the everything rally yesterday? We had some of the stocks that were already pretty richly priced gain immensely yesterday. I'm looking at, some of the software companies up 10%. So it was yesterday just buy everything, despite valuation.
It was buy everything, catch something that was running if you want to trade momentum, covering some shorts if you're seeing big moves against you. And I don't think much really changed. It's a marginal positive. I don't think the Fed's going to have to do 75. I don't think they're going to get above 5% on Fed funds, not because of good news, though, but because the economy is going to slow. There are starting to be some layoffs. The job situation is still very robust in the United States. But the hikes that are coming are going to destroy demand and are going to create some unemployment. And we're going to have a U.S. economy that's flirting with recession. So I think things aren't as scary as they might have been, but they're far from good.
No. So do you think inflation has peaked?
I think it's peaked for right now, and I think Milton Friedman would come back to M2 growth. It's 2.6% year over year. The money supply in aggregate in the United States is lower now than it was 2 months ago. So that's a big macro view of inflation, and you've got the Fed destroying demand with its higher hikes. You've had commodities roll over. So I do think inflation has peaked for this cycle. I think the Fed's doing its job. They've been behind the curve. I think they're at the point now where they're not behind the curve. They've gotten to a level where they are putting in interest rates and quantitative tightening that is killing off some demand and keeping prices from moving higher.
Patrick, what do you buy right now with the biggest conviction?
Within equities, I like luxury companies because their consumers aren't being impeded by higher utility bills, petrol prices, mortgage costs. If you were going to spend $2,000 on an Hermes scarf, it doesn't really matter that your petrol prices went up or your utility bills. So I think their revenue line is very secure. Their input prices don't matter to their profit margins. So I really love that sector. It's a little bit expensive, but not markedly so. I think you still want to own oil and gas companies because they're killing the profit margins elsewhere. I think oil prices are going to be sticky. You've had no exploration and development for new oil. So even though demand may slow, it's not going to really deteriorate massively. And you're not getting the supply response that you've got in previous cycles where oil's hit $100 a barrel. And agribusiness equities is another one where I think you're going to have very good profit margins, a string of beats. Yeah. Global warming, climate change is creating droughts in some areas, floods in other areas, and farmers are going to have to farm every acre of arable land. So I think pesticides, fertilizers, farm equipment, those are areas I really like right now.
Patrick, is there something else? You know, a lot of the rally that we saw was also the reopening of China. If it doesn't go into a smooth sailing, which we're expecting it to be, maybe stop and start like we've seen over the last 3 years, is there a danger that equities track that stop and start on what Chinese authorities do?
It's very hard not to fall into it, and I think calling it a trap may be fair. That no one has an idea what China's policies are going to be relating to COVID and the zero COVID policies. It's a massive headwind to their economy and to their stocks. Trading off of it is going to be difficult. I'm not playing China right now. I'm short still some of the companies that are really reliant on U.S. semiconductors. I don't think that's an issue that's going to change markedly quickly, but they are cheap if China did reopen. All the equities in China right now. It's an if that I can't answer, though.
Patrick, when you look at dollar strength, again, have we reached peak? And what does that mean, for example, for your investing in emerging markets?
I don't know that we have reached peak. I think the Fed is going to slow its pace of hikes almost definitely as the economy slows. But European economies are in a much worse position. So their central banks are going to not be hiking as well. I think interest rate differentials are still going to create dollar strength, more muted dollar strength than we've seen. But the carry you get for being long dollar assets versus European or UK assets, the Bank of England's talking about a 2-year recession we're going to be stuck in for the coming quarters as well. So I'm still moderately long dollar. I like the carry you get with it, but it's probably 90% done, the dollar rally. But the carry you get, even if all currencies stay equal, favors a dollar position.
Okay, anything to do with yen right now?
I'm short yen versus euro. I don't think the Bank of Japan is going to be able to keep their yield curve control in place with all other central banks hiking aggressively, the US probably getting to 5%. How does the Bank of Japan keep 10-year yields at 0.25%? It's going to create flight out of yen into higher yielding assets. So until they change that peg, I think they will. I'm short 10-year Japanese bonds, and I'm short the yen versus the euro. They both carry currencies, and I think the yen is probably going to be weaker based on it's still doing quantitative easing and still capping interest rates at 0.25%.
Okay, brilliant. Patrick, thanks so much. Patrick Armstrong there, Plurimi Wealth Chief Investment Officer, stays with us. Coming up, crypto continues to take a hammering as problems multiply for troubled exchange FTX. More on that story next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacqua here in London. Now, SoftBank is said to be expecting to take a $100 million hit on its stake in troubled crypto exchange FTX. The meltdown of Sam Bankman-Fried's FTX has sent crypto markets into a tailspin this week. While Bloomberg crypto blogger Emily Nicole joins us now. Emily, you're really an expert in this field. What's happened in the last 3 weeks?
Well, it's not even been 3 weeks, it's been a week. That's how fast these things have been going. FTX first kind of revealed that it was having some issues on Monday as users were unable to withdraw their tokens in a timely manner. And since then, it's all been downhill. They surprised us with saying that they were entering into deal talks with Binance, a rival, to rescue the firm. Those then fell apart in a day later, and now it's in talks with Justin Sun from Tron to see if it can be recovered there. But in the meantime, there's been several probes announced, investigations by the SEC and the CFTC. Assets have been frozen in the Bahamas, and there's been contagion elsewhere with other companies saying they have exposure to FTX, and some of those are having to also halt withdrawals now because of that.
So does this get much worse before it gets better, Emily? We also had a conversation with Justin Sun of Tron, and frankly, it was unclear to me, A, how much he thinks FTX needs to be shored up, and what exactly he's trying to do.
We've reported, at least at Bloomberg, that the shortfall is going to be at least $4 billion to cover needing fresh funding to get the business going, and maybe the hole could be as big as $8 billion. Justin Sun did say that he's not sure of the exact numbers yet, but he's prepared to kind of meet those kinds of terms. But it's all subject to due diligence, and Binance only had a day to look at FTX's books before deciding it wasn't for them. So there's definitely no guarantee that there's going to be any deal forthcoming.
So what happens if there's no deal? What happens in the crypto space overall?
Well, for FTX, it'll mean that it'll need to start thinking about winding up. It's based in the Bahamas, which means that this is really just the international side, not so much its US exchange, FTX US, although that is also saying that it will have to pause withdrawals in the coming days. So we may be seeing things like going through bankruptcy filings. We've had quite a few of those in the Bahamas this year with other companies that have failed. And with the investigations that are ongoing, there's also the suggestion of whether or not there was some proper handling of customer assets as well. So that could be in our future.
All right, thank you so much. As always, a Bloomberg crypto blogger, Emily Nicole. Now let's get back to Patrick Armstrong, who's Plurimi Wealth Chief Investment Officer. Patrick, you don't have exposure to crypto, right?
No, I've been a crypto skeptic for some time. I think there's a lot of promise with crypto, but the reality of what cryptos can deliver and versus what the hope they may be able to deliver one day, it's still not there. It's not a medium of exchange, it's a speculative asset. And if truth be told, I think it's 99% of participants are in it to make a profit for no other reason. And speculative assets, when they run out of steam, it's hard to get that steam back in it. But Bitcoin has been the exception to that rule as well. So in 2017, when it spiked and it did plummet, it did rise from the ashes in the past as well.
So do you think it'll rise from the ashes this time, or is it just too soon to call it?
I don't think it will until it serves a meaningful purpose other than a speculative asset. And it's got the promise that it can be used as a currency, a medium of exchange, a store of value. Maybe you have some argument that it has been a store of value recently. It's been relatively stable. It's not a medium of exchange, and I don't think there's a real path where it becomes a medium of exchange. So it's down to being a speculative asset. And speculators get bored when things don't go up. So my view is there will be a crypto that's everything Bitcoin is, and it's better, and it will be used as a medium of exchange, and that will replace and disrupt Bitcoin. It's not there yet. One day that'll happen, and for me, I don't see a reason to own Bitcoin if you've got a better alternative that has everything Bitcoin has, a limited supply, and can be used as a medium of exchange.
Patrick, talk to me a little bit about UK assets. Is there anything that you're buying right now? So we're, a week or even 6 days away from that fiscal statement. A couple of things have been leaked to the media and the press about what the Chancellor wants to do here in the UK.
I love UK corporate bonds from the banks, and unfortunately, I've been in the shorter duration end because the yields are they're enticing at 6 and 7% of BBB plus banks with a 2-year duration. Wouldn't have got punished if interest rates really moved higher because of that pull towards par. As interest rates have come down, it would have been better being long duration, but I still think that's an incredible risk-adjusted return to buy a Lloyd's, a Barclays, a Credit Suisse is still yielding 7.5% in sterling. Everyone's worried about banks because that was the epicenter of the crisis in 2008, but regulation's much better now. Capital positions are much better, and I don't think the banks are going to be in distress in the next crisis because of the regulation, the capital adequacy, and all the off-balance sheet risks are much better accounted for now.
So, Patrick, going forward, I mean, is there a specific type of corporate bond that you like in the UK, or when do you see a turning? When do you get into UK assets? Is it still like catching a falling knife, or is it easy to call bottom?
Yeah, I've been in the assets that are the multinational. So I own BP, I own Shell, I own AstraZeneca, the multinational companies that haven't been exposed to the weak sterling. We've had a very strong sterling now for a month, but with an economy that's really probably going to lag the US in the coming years, I do want companies that are the multinational. So the big cap equities with dollar revenues, and you are getting a big spread on bonds in general. So I'm attracted to that as well.
Patrick, thank you so much. Patrick Armstrong there, Plurimi Wealth Chief Investment Officer, on some great calls and what actually he wants to do going forward. Now, coming up, we speak to the Saudi Energy Minister, Abdulaziz bin Salman. Don't miss that exclusive interview from our Yusuf Gama Eldin. That's from COP27 in Egypt. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Garrett. Hi, Leanne.
China has reduced the amount of time travellers and close contacts of virus cases must spend in quarantine and pulled back on testing. Chinese shares gained on the news a significant calibration of the COVID-0 policy. This as daily virus infections exceed 10,000 for the first time since April, with Beijing's cases at the highest level in more than a year. Now, world leaders are gathering in Cambodia for the first of 3 back-to-back meetings in Asia. President Joe Biden at the Association of Southeast Asian Nations Summit will push an alternative vision for the Indo-Pacific region designed to counter Beijing's growing influence. This ahead of the American president's meeting with Chinese President Xi Jinping at the G20 in Indonesia on Monday. The U.S. is sending additional weapons to Ukraine, including Avenger anti-aircraft systems made by Boeing. This as Ukrainian forces move deeper into Russian-occupied areas of the southern Kherson region, a day after the Kremlin ordered a withdrawal. Kyiv says its troops have advanced 7 kilometers in the last 24 hours, liberating 12 towns in the region. Kwasi Kwarteng, who was sacked as Chancellor after that ill-fated mini-budget which saw UK assets plunge in value, has blamed Liz Truss for going too far and too fast with her economic reforms. In an interview with Talk TV, Kwarteng said he warned the Prime Minister it would lead to her downfall. Truss was forced to quit after less than 7 weeks in Downing Street. Bloomberg has learned that Elon Musk has told Twitter staff that bankruptcy is indeed a possibility if the company doesn't start generating more cash. Twitter has a significant debt burden from the acquisition, with some funds said to be offering to buy paper for for as little as 60 cents on the dollar, a price typically reserved for companies deemed in financial distress. Amazon shares have jumped on news that the CEO Andy Jassy is embarking on a review of expenses as part of a broader effort to streamline operations amid a slowing economy. The e-commerce giant has already paused hiring across the entire company. SMIC's third quarter earnings missed expectations despite seeing a 47% jump in net income. China's largest chip maker blamed the tepid outlook on weak demand, along with increasing U.S. curbs on access to chip technology. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, we'll hear more from the Tron founder, Justin Sun, about his potential plans to help distress crypto exchange FTX as prices continue to slide. That's coming up shortly, and this is Bloomberg. Well, past the peak, U.S. inflation cools more than expected, fueling optimism. The Fed has room to slow the pace of rate hikes. China turbocharges the rally. Beijing eases quarantine rules, propelling markets higher. European stocks start the day higher as well. Plus, crypto crisis. FTX founder Sam Bankman-Fried is said to face an SEC probe amid ongoing mayhem. More of an interview with Tron's Justin Sun this hour. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Tron founder, Justin Sun, has indicated he's opening to helping troubled crypto exchange FTX. Sun spoke to Bloomberg's Tom McKenzie and I a short time ago.
Right now, I think the most important thing is still we need to do a full due diligence, and at the same time to evaluate the situation, to have a full picture of like what's going on, like how serious is the liquidity crunch. So basically, once we get the full picture, I think we will start to making moves.
Well, that was Tron founder Justin Sun speaking to Bloomberg about the crypto mayhem and a potential bailout of FTX. Now let's dig into the story a bit more with Eddie van der Walt, Bloomberg's Markets Live deputy managing editor. I'm so excited I'm speaking to you, Eddie. It's been way too long since you've come on air. Are there there are dominoes, right, because of the crypto fall. But how do they get back up from this?
You know, this is such an interesting story. There are so many twists and turns in it, right? I mean, every day I woke up and there's just a new chapter being written. You're exactly right to point to the dominoes, because I think that is the worry here, that we don't know who had exposure. We don't know, who's also now, with cryptocurrencies again on the retreat, which other exchanges are going to be found to have not enough liquidity as investors rush to pull out their funds. So, it does feel a little bit like that Lehman moment. It does a little bit feel like we're going to find out, exactly what the cross currents are in the coming days. I don't think we've seen the end of it yet.
So what is this, like watershed moment? Is this the moment where they became systemic, or how would you describe this moment?
Yeah, in terms of them becoming systemic, I think that's really interesting. Obviously, we're not, at this moment talking about a major hedge fund or a major bank, traditional bank falling over. But we did see stocks and risk appetite sour, on the back of this on Wednesday, right? So at this point, cryptocurrencies are no longer a side note to the main markets. They are very much in the mainstream, and they affect retail sentiment and they affect wider markets. And I think, therefore, regulators are going to start paying notice.
Yeah, I mean, what I find incredible is it's only like a month and a half ago that we're talking about how it was stable to a lot of other currencies, and it was actually tracking the economy.
Right.
I mean, are you amazed at how things quickly, how quick things turn around?
Oh, yeah, absolutely. I mean, it's not, a couple of weeks ago, there was charts out there that said that Bitcoin was about as volatile as the pound. Now, I think that's turned around very quickly. But it just does show you that this is still a very immature space, right? And that investors who buy into cryptocurrencies still need to be careful, because there are a lot of risks. I think, though, the industry has matured enough. We have exchange-traded funds. We have futures markets. people can hedge their risks if they want to.
So what does it mean? If you're an institutional investor today and you've kind of toyed around with the idea, or maybe you have an exposure, do you rethink that?
All right. I think institutional investors will want some of this volatility, right? Because it's equally as explosive to the upside. No, right. I think that it's equally as explosive to the upside. Bitcoin's almost more explosive to the upside than it is to the downside, right? So I think institutional investors will want to take exposure, but they will want to do it in a smart way. I don't think your institutions are going to buy on off-exchange products. I think this makes particularly those futures contracts and ETFs that we talked about, more enticing. I think the traditional tools for getting into cryptocurrencies will benefit as a consequence of this.
Eddie, there's one thing, when we've been looking at more of the traditional markets for a long time, is that if you say you're going to buy something and you don't buy it, it looks really bad for that target.
Right.
Did Binance really make it worse for FTX? And are we going to see the same from Tron?
That's a really good question. I think if we see another deal collapse, that is very damaging for the brand, because then two people have had access to the books and said,
I'm not
no,
touching
thank
it.
you, right? And I think there's a lot of people right now in markets broadly that are assuming that it's worse than it looks from the outside. So yes, I think the Tron deal is absolutely critical.
So what are you looking at? I know that we had figures, and we spoke to Emily Nicole about, maybe they need $4 billion just to keep operational, but to swoop it up and put it in better shape, they need $8 billion.
Right, that's the question, right? And I think any investor will want to make sure that they are covering the retail investors, but not the holders of the company, right? They will want to make sure that that's the case. And I think any outside investors will want to know that there is not going to be, more landmines down the road for them.
Yes.
So I think there's a lot of questions to be answered here. I don't think it's a done deal that this goes through. I think showing an interest I think it's a good thing to do, to just take a look.
And I know there's a bit of a lack of transparency of who holds some of these tokens and who's behind this. But could you see a moment where regulators need to step in to try and safeguard the people invested? A lot of people would have lost money, and it could be, like people that would put them seriously at risk.
I think this is exactly the moment where regulators had to step in. I think because in the past, with
protection, you think?
No, I don't think so. But I think in setting the rules for the industry, because right now we have seen cross-contamination from cryptocurrencies to wider markets, and therefore they are now systemic assets, right? They are no longer isolated from mainstream finance. But the thing is, I think there's a lot of regulators talking tough about this. I think the regulators are also playing hot potato a little bit, right? It's a bit like a few years back we had, traders didn't know on which desk to put this. And the currency trader said it's not a commodity, and the FX trader said it's not an FX. I think it's the same sort of thing. I think the regulators are talking tough, but they're not sure that they really want oversight of this, because there's so many undiscovered black holes.
But you see it exploding actually on Twitter, right? And people saying, I can't get my money out, this is happening to me. If you're that person, you can't go to anyone.
Right, exactly. There is nobody to go to. But I think, retail investors should always take note. And they do get a lot of warning, but still a lot of them don't know because they are not professional investors. But they should take note that this is still pretty much the Wild West. If you go to cryptocurrency exchanges, you are exposed to the exchange's underlying liquidity.
Eddie, thank you so much. Eddie van der Veld there, Bloomberg's Markets Live Deputy Managing Editor. As always, great insight into some of the crypto world. Now, the UK economy shrank in the third quarter, marking the start of what is expected to be a protracted recession. GDP fell 0.2%, leaving Britain as the only G7 country that has yet to fully recover from the pandemic. Now, Bloomberg's Lizzie Burden joins us with the very latest. Lizzie, if you look at the GDP number, what stood out at you?
Well, this is a contraction on the quarter, not as big as expected, but if you zoom in on September, it was a bigger contraction than was expected. That's because, of course, we had the bank holiday for the Queen's funeral, a general weight on consumer sentiment. And for many months now, we've had the cost of living crisis, high inflation, high interest rates weighing on consumer services. But what's interesting this month in September is you can see it spreading to B2B as well. So one of the hallmarks of a recession. And we are expecting a protracted recession, the likes of which we haven't seen since the 1990s. The depth of it is going to depend a lot on what the Chancellor Jeremy Hunt does next week. Take a listen to his reaction to these figures.
Well, the Bank of England says that we are likely to be in recession. This is disappointing but not entirely unexpected news. And what we need to do now is to present a plan to the country to tackle the root cause of the issues we face, which is inflation, and a plan that protects the most vulnerable. And that's what I must do next Thursday.
So more expectations management from the Chancellor, Jeremy Hunt, there.
So, Lizzie, what are we expecting from the fiscal statement? November 17th, really the date that's been tattooed to our brains.
Yeah, well, Jeremy Hunt and Rishi Sunak really face an impossible task because they've got to please the markets. We know what happens when you don't after the Truss mini-budget, but they've also got to please the voters. And the elephant in the room here is they've got to bring down inflation, which means controlling demand. So we're expecting lots of measures that are not so visible. Stealth tax rises, a freeze on government spending after the next election, and a stop or delay or a cancellation altogether of some of the shovels going in the ground, infrastructure projects. But really, that's going to have consequences in the long term, both for growth and levelling up.
Lizzie, what's the most difficult decision the Chancellor has to make, actually, next Thursday?
Well, he's got to prioritise bringing down inflation, but he's also got to show that he can boost growth. Growth was what Truss was all about, growth, growth, growth. But if they want to have a hope of winning the next election in 2024, there's got to be some positivity. They can't be seen to be just managing Britain's decline. And this is why, as I say, I go back to the Mays lecture from Rishi Sunak in February. His positive vision is about building a culture, a culture of enterprise, as he put it, based on capital, people, ideas. So expect to hear about R&D, boosting business investment and skills.
Lizzie, thank you so much. Our Lizzie Burden there with the very latest on the UK. Now, coming up, Bloomberg's Youssef Gamaeldin speaks exclusively to Saudi Arabia's energy minister. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Elon Musk has told Twitter staff that bankruptcy is a possibility in his first address to employees since the takeover. Well, Bloomberg's Sue Keenan has more from New York.
Elon Musk finalized his $44 billion buyout of Twitter, as we know, then proceeded to lay off half the staff, recalled some of them back, and now this was his first hands-on meeting, all hands on deck. Those remaining employees and sources who were there tell us, he said, bankruptcy is a possibility if the company doesn't start generating more cash. Now, he had sent out an email the day before saying he wasn't going to sugarcoat the message, and he did not. He told workers no more perks like free food and working from home, and that they should brace themselves for 80-hour work weeks. Now, the warning comes amid a tumultuous start to Musk's role as what he calls the chief twit at Twitter. He immediately ousted the top tier of management involved in the company back 2 weeks ago. Now Bloomberg has learned 2 of the top remaining execs have resigned. They were involved in compliance and privacy. So that raises concerns about the company's ability to comply with regulations and oversight, which are significant. Musk also said earlier that Twitter is burning about $4 billion of cash a day. That's a significant burn, and that advertisers have backed away given the lack of clarity over who's in charge. Meanwhile, the 7 banks trying to sell the debt they used to finance this deal are finding it no takers unless there's a discount. Back to you.
Bloomberg's Sue Keenan there from New York. Now let's get straight to your Bloomberg Business Flash. Here is Leanne Garrett. Hi, Leanne.
Hi, Francine. China has reduced the amount of time travellers and close contacts of virus cases must spend in quarantine and pull back on testing. Chinese shares gained on the news, a significant calibration of the COVID-0 policy. This as daily virus infections exceed 10,000 for the first time since April, with Beijing's cases at the highest level in more than a year. Now, SoftBank's Core Vision Fund arm has posted a 7.2% $1.2 billion quarterly loss due to write-downs on its tech investment. The billionaire founder Masayoshi Son turned his telecom company into the world's biggest startup investor, but the effort has seen him recently buy a sharp downturn in tech valuations. Amazon shares have jumped on news that the CEO Andy Jassy is embarking on a review of expenses as part of a broader effort to streamline operations amid a slowing economy. The e-commerce giant has already paused hiring across the entire company, and SMI Seed's third quarter earnings did miss expectations despite seeing a 47% jump in net income. China's largest chip maker blamed the tepid outlook on weak demand, along with increasing US curbs on access to chip technology. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, we'll take a look at what's been driving markets today. Don't miss that. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Saudi Arabia has established a facility on its eastern coast to capture carbon. That's as the world's biggest oil exporter seeks to reach its goal of neutralizing emissions by 2060. Now, Bloomberg spoke to Saudi's energy minister exclusively at the COP27 climate summit in Egypt earlier. We also asked Prince Abdulaziz bin Salman why climate activists are wrong to see Saudi Arabia as the enemy.
Absolutely, they are wrong. They're more than wrong, and they can come here, visit us in this exhibition, and attend to all the ambitions that we have promised to do last year. And I have made a presentation just a while ago how much of these promises were fulfilled. As you know, the COP this year is about fulfilling ambitions. We're making ourselves accountable for our own ambitions that were declared by the Crown Prince last year. In fact, we're gonna move, we did move the Saudi initiative and the Middle East initiative to be more commensurate with the COP, which is to make sure that the very population that attend the COPs will be able to come here, see us, talk to us. We have lots of activities apart from sessions and what have you. Even in the blue zone and the red zone, we're hosting events or participating in the events. We really are so proud of what we've been achieving, what we'll be achieving. In fact, we are setting an exemplary model for hydrocarbon or energy producer, or even consumer. As you can see in what we have presenting here, we use the design of circularity. This is where we have been anchoring ourselves, which is the circular carbon economy. We have been aspiring to do all of the above with the reduce, the efficiency, the energy mix transformation that we're going through. And we're going to go for an energy mix thing. We'll do all of the above. We'll do the renewable, both solar, wind. We will do the hydrogen. We actually are working with Aramco and others to go even to geothermal. We're doing the nuclear. As I said, we're doing the efficiency. We really believe that we are setting ourselves to become an energy, not only producing, but energy even exporting country, because we're approaching countries with the idea of exporting hydrogen to them, to even exporting electricity to them. So we're going to do all of the above, and we're going to mitigate also using all of the above.
Last year, at the end of the COP, there was an agreement to phase down the use of coal. Would the Kingdom be happy to see a COP ever write into its agreement that the world should phase down the use of oil?
I think with oil, no. I think, first of all, what transpired out of Glasgow was unabated coal. I believe the world needs all sorts of energy. And I believe that Paris Agreement was not about getting rid of that source, or it is not about getting rid of sources. It is about mitigating the emissions.
Well, that was Saudi Arabia's Energy Minister, Prince Abdulaziz bin Salman, speaking exclusively to our Will Kennedy. Now let's get more on what's moving markets in the second hour of European equity trading with Bloomberg's JP Barnett. JP, look, you look at equities, and actually they're rising on the back of that CPI number and China reopening.
Yes, absolutely, and they're rising massively. What we saw yesterday was something that is called a 4 sigma move, so 4 times the normal daily move of the S&P 500. That only happened on 9 other days during the last 10 years, 8 of them during the March 2020 sell-off. So that shows you how massive that move is. And I think like the biggest thing that we learned yesterday, besides inflation coming down more than expected, is that positioning in the market is eclipsing everything. There was a huge amount of short positioning in the market. We saw very light positioning among those that are long only. And this is being corrected now with shorts being covered, people probably chasing this rally for a little bit longer. And that's why we saw this massive move yesterday. Maybe we consolidate a little bit today after such a move, but I wouldn't be surprised if this rally has legs.
So, JP, what are you looking for next?
Well, the major thing that we need to keep in mind here is the inflation path. So that inflation is coming down now finally. It's more like of a mathematical thing. So the big question now for investors to look into is like, how fast will it continue to move lower? And what will happen if we suddenly like maybe get stuck around like 4% or 5% inflation? How will the market digest that? The other thing that is very crucial to watch is how earnings are going to develop further. The third quarter earnings season was showing some weakness in corporate margins. So we will see like how the fourth quarter is playing out, how the corporates are guiding us for 2023, and what analysts are doing with their estimates. These two things are the major things I would look out for.
So, JP, you think the rally sticks?
Well, I guess it can a little bit. We have a few weeks now to the next major data point. As I said, positioning is driving this market, and that usually can go a little bit longer. So if we see another 2 or 3 weeks of decent gains, maybe not like so dramatic like yesterday, that shouldn't happen, but like a slow grind higher towards the 200-day moving average, maybe for the S&P 500, that would be another like 4 or 5% higher. That would be reasonable in my view.
All right, JP, thank you so much. JP Martin there with the very latest on some of these equity moves. Now, Bloomberg Surveillance early edition continues in the next hour. Not only will they go through the CPI data from yesterday, they'll also look at China opening, and then everything and anything is really happening in the crypto world. So they'll have a full roundup of what's going on there, and then more for our exclusive interview with the Saudi Arabia Energy Minister. That's coming up shortly as well. A reminder, Treasury is actually closed today because of Veterans Day. The other market moves as we look at dollar strength, whether that's the end of it or certainly whether it's peaked, just like inflation has. And then the UK economic contraction, does it herald the start of a protracted recession? Certainly really feels like it. But then the drop was actually shallower than economists expected for the first time since the first quarter of 2021. It still means, though, that Britain is the only group of 7 economies that has yet to fully recover from the pandemic. This is Bloomberg.
Been a recurring nightmare for investors as inflation has been very, very slow to come down.
One has to be careful about losing sight that it still remains a long way back to 2%.
The problem is we haven't really, I don't think, discounted the weakness in the economy that's coming.
There's, some evidence that we are moving from peak inflation down lower. Where do we end up, I think, is the big question.
General pessimism, anything that's bad but not quite as bad as people expect, maybe setting the floor under equities and risk assets.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The rally carries over into a second day. European stocks and U.S. futures are rising again as China adds to the euphoria triggered by falling inflation in the world's largest economy. Crypto's rollercoaster ride. Bitcoin falls a day after soaring. The market's still feeling the effects of FTX's downfall. And the British economy shrinks, heralding the start of what may be a protracted recession. The Bank of England sees it lasting into the middle of 2024. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Chrissy Gupta in New York. Kailey Leinz is off today. Let me come to you, Chrissy, then, in terms of these markets. I mean, how many triggers for risk on do we need in 24 hours? First, the US inflation print, and then the China news.
Well, given that we've had about 10 months of doom and gloom, I say it's about time, especially for the bulls. But to your point, it is kind of that risk rally that you saw in yesterday's session that's really kind of flown and that's really powered a lot of what's going on in the Asian session. In fact, the MSCI Asia Pacific Index had its best day going all the way back to 2009. That's how big this rally was, really globally and around the world. But to your point, Anna, it's not just about simply this less than expected a CPI print, less hotter than expected CPI print. Also, this idea of China reopening, that is good news. They're basically changing the quarantine rules when it comes to even entering the country. You only have to stay in a hotel for 5 days now. At peak COVID, that was almost a month in quarantine before you could get in. So that is a major game changer, not just for China, but for the global economy that's talking a lot about access to that market. Nevertheless, powering stocks, you did see the Hang Seng up 7.7% on that news. Plus, like I said, the tailwinds of what happened in the U.S. session. We can't just stop at China. We got to talk about Japan as well. One of the major stories in the last year, I want to say, is this idea that Japanese interest rates are so ultra low. The yield curve control in the BOJ isn't working so much to the point that the Japanese currency is now weakening. If you then have slower inflation in the United States, those interest rate differentials change a little bit. The dynamic changes, which means you start to see some technicals play into the Japanese currency. And that's exactly what you're seeing here. Dollar yen testing that 140 level right below with a 139 handle right now, weaker by about 1%. But that sentiment is enough to, of course, power the Nikkei up about 3%, Matt.
Yeah, first time we've seen that kind of yen strength. They're going below 140 since September. So very interesting story. I would say it pales in comparison, though, to the mega rally that we saw yesterday with the S&P over 5%, the NASDAQ gaining more than 7%, the biggest gains that we've seen since trillions of dollars in fiscal injections were announced in 2020. So it's amazing to me that we're also continuing to see gains in futures after that. So really, the bulls have had their day. Maybe it was a short squeeze yesterday that exacerbated the gains that we saw after the CPI print, but it looks set to continue. Is it really on the back of loosening Chinese COVID rules? I mean, you still have to stay in quarantine for 5 days in a hotel and then 3 days at your home, assuming that you have a home there when you're going. Bloomberg Dollar Index coming down a little bit. That is due in part to the strength of the yen, but also you see strength in the euro, as well as the pound against the dollar index. And maybe this is also just more risk on sentiment. You can get out of safe havens like the dollar. There's no treasury safe haven to be in today unless you bought before the close yesterday or at the open tomorrow, because it's Veterans Day. So the bond market, respectfully takes the day off. I don't know why the equities market doesn't honor Veterans Day. NYMEX crude up 2 2/3%, 89.15 a barrel. So we see gains across oil as that risk on sentiment goes into other asset classes. And Bitcoin coming off, but it had a banner day yesterday. It's now back to 17,369. It's almost as if the FTX implosion never happened. But of course, that story continues to develop, and we're going to continue to bring you headlines on that. Anna, what do you see in terms of Europe?
Yeah, we'll certainly get more analysis on the crypto story later. Well, this is the European picture. We're distilling, of course, all that enthusiasm on Wall Street yesterday. We got a chance to price some of that in here in Europe yesterday, but not all of it. The Nasdaq up by more than 7% by the close, of course. Plus, we're adding in the enthusiasm that we saw through the Asia session for what's going on in China. Hong Kong markets, for example, partying like it's the end of the 1990s. So this is what that all looks like here in Europe. Not quite such enthusiastic moves, but we are stronger. The CAC 40 in particular up by 0.8%. 0.5%. Just to point out, we have heard from the EU just in the last few minutes, the European Union cutting its 2023 Eurozone GDP outlook to 0.3%. It sees more inflation. So bringing down the GDP outlook, pushing up the inflation outlook, that's not the direction of travel you want things to be moving. How does the news out of China, how will that change that, shape that in the months and the weeks to come? These are some of the assets in focus here in Europe. The pound, 117.51. More on this with Lizzie in a little while. But really, it's the big global pictures that are driving the pound rather than the UK data. But we have had UK data out today. We are now in contraction in the UK economy. Will it be a recession? Will we get another quarter to back that up? That is the expectation. The euro getting a really big bounce off the back of that CPI data. Reduced interest rate differentials between the United States and the Eurozone. That helps. 102.63, just checking in with where we are there. 96.34, Matt had the WTI price. I've got Brent up by 2.9%. This is where we've seen some of the read across into Europe from that news out of China. So as China starts, even at the margin, to signal opening up, we do see a bit of a move higher in Brent crude. What does that mean for inflation going forward? A question for another day. And this is the Richemont share price, up by 11.3%. Whether you look at the numbers they reported or whether you look at the China news flow, all of that adds up to something really positive then, Chrissy, for the luxury goods sector. Somebody somewhere buying a lot of watches.
It certainly isn't me, I have to say. A lot of green on the screen, of course, powering the bull case. But you have to say the bear case really does rest on potentially those recession odds. Maybe we can't get out of this without ultimately hitting a proper recession with those big layoffs. And that's certainly something we're going to be watching, especially following that cooler than expected US CPI bet that actually has been increasing. Perhaps bets for another jumbo rate hike, still paired with several Fed officials backing a downshift. Take a listen.
While I believe it may be appropriate to slow the pace of rate increases so we can better assess how financial and economic conditions are evolving, I also believe a slower pace should not be taken to represent easier policy.
In the upcoming months, in light of the cumulative tightening we have achieved, I expect we will slow the pace of our rate hikes as we approach a sufficiently restrictive stance. But I want to be clear, a rate hike of 50 basis points would still be significant.
Stepping down is an appropriate thing to think about. It is not to be confused with adjusting the terminal rate. By terminal, I don't mean the end rate we'll ever have. I mean the rate at which we would raise to hold.
A more measured approach to rate increases might be particularly useful as policymakers judge the economy's response to higher rates. Already, we've seen the committee's policy actions lead to a very sharp tightening of financial conditions.
For more analysis on the post-CPI rally, let's bring in Bloomberg's market reporter Valerie Teitel. Valerie, walk us through it.
Yeah, thanks, Critty. Now, just to show you how incredible the market reaction was to yesterday's softer than expected CPI print, I've got a chart here of the financial conditions index. Now, the easing we saw yesterday was extraordinary. That's reflected in the rally in the stocks and bonds and the sell-off in the dollar. So extraordinary, it basically parallels what we saw after the $2 trillion COVID stimulus package was announced in the U.S. Just think about that. The market reaction yesterday equated to how the market reacted to $2 trillion of stimulus. Now, we think, does this change the calculation for the Fed? Well, it likely takes 75 off the table in December, yes. But with this kind of reaction, this kind of easing in financial conditions, I really think we're going to see some Fed speakers coming out swinging hawkish in order to downplay the movement that happened yesterday.
All right, well, we're starting to see that to some extent already. Valerie, thanks very much. Valerie Teitel there talking us through the massive mega rally that we saw yesterday. You can see Valerie's charts and all of our terminal analysis if you just type GTV Go on your terminal, plus I sprinkle them in throughout the day. Let's get over to crypto now. The SEC is deepening its probe into the crumbling FTX empire. Bloomberg has learned that the regulator is investigating the CEO, Sam Bankman-Fried, for possible violation of securities rules. This should come as no surprise, but it does come after Binance pulled out of a deal to rescue FTX. Binance, of course, kind of made the deal necessary in a sense as well. The CEO, CZ, spoke at, I should say, the Indonesia FinTech Summit earlier.
From our perspective, the deal did not make sense from a number of fronts. From a financial perspective, it's a big hole. From new users, FTX, we have very high overlap. We cover all the regions they cover, and they have much less users than us. From a technology or product perspective, I think we have a superior product. They don't have anything that we don't have. So our original intention was to let's save the users. But then the news of misappropriating user funds and especially U.S. regulatory agencies' investigations, we're like, okay, we can't touch that anymore.
Now, Tron has stepped in to help rescue FTX. Justin Sun says he's in fundraising talks with Sam Bankman-Fried. Sun spoke with Bloomberg's Tom McKenzie earlier.
Right now, I think the most important thing is still we need to do a full due diligence, and at the same time to evaluate the situation, to have a full picture of like what's going on, like how serious is the liquidity crunch. So basically, once we get the full picture, I think we will start to making moves.
McKenzie joins us now for more on his interview with Justin Sun. By the way, is Justin the guy who bought the Beeple NFT for like $69 million?
He does fall into that category. He also wined and dined with Warren Buffett. I think he paid over $10 million for that. And interestingly, he's also the ambassador for Grenada as well, Matt. Look, you know this story really, really well. So we spoke to Sun because he could be, and there's a big caveat there, the next knight in shining armor to come to the rescue. Really interesting to hear from Changpeng Zhao then, Zhao Changpeng, of course, CZ of Binance, outlining his concerns about this deal. Tron, and we know this, his team were talking to me just in the last hour or so saying that Justin was up all night with his team doing this due diligence. He's going through the numbers, him and his team. They want to try and come to some conclusion. He said, and he told us in this interview, he is ultimately prepared to put billions of dollars into this deal, again, if it aligns and if the numbers work out. Big caveats there. We know there's that regulatory challenge as well. Of course, the Bahamas, where FTX.com is listed, or at least is based, they have frozen the assets as well. Justin Sun saying, look, he wants to do this in terms of solidarity for the space, for the crypto space. Clearly, he has his own self-interest to try and make this work. But there are going to be major challenges for him to get this over the line. He has made one important step, which is he's persuaded FTX to release some of the coins, some Tron coins and some Huobi coins, because he's a key advisor on that exchange, Huobi, out of FTX.com. So that's one of the first steps. Now he's doing his due diligence. And again, he told us he's prepared to put billions into this ultimately if they can make this work.
Bloomberg's Tom McKenzie, we thank you as always. Another company facing potential bankruptcy, Twitter. Bloomberg's learned that Elon Musk has told Twitter staff that bankruptcy is a possibility if the company doesn't start generating more cash. Twitter has a significant debt burden from the acquisition, with some funds said to be offering to buy paper for as little as 60 cents on the dollar, a price typically reserved for companies deemed in financial distress. Anna, this is a fascinating story that has really evolved very quickly. It's kind of hard to not watch the investor reaction now that Twitter is really not part of the S&P 500 anymore, not even publicly listed. Nevertheless, still a story that we're going to be watching from around the world.
Yeah, such a huge player in many global economies, global democracies, that no doubt we watch it and continue to do so. Now, the UK economy shrank in the third quarter, making the start of what is expected to be a protracted recession. For more, we're joined by Bloomberg's Lizzie Burden. Lizzie, break down the GDP data that hit a few hours ago.
Well, Anna, we did see a contraction in the third quarter, but not as big as was expected. But if you zoom into the September figure, it was a bigger contraction than was expected. Why? Because you saw the weight of the cost of living crisis on consumer services, high inflation, high interest rates. And interestingly, that is now spreading into B2B services, a hallmark usually of a recession. But the depth of that recession really is going to be dictated by what the Bank of England does from here on out, and also the Treasury. We've got a fiscal statement coming up next week. Take a listen to how the Chancellor, Jeremy Hunt, reacted to those GDP figures this morning.
Well, the Bank of England says that we are likely to be in recession. This is disappointing, but not entirely unexpected news. And what we need to do now is to present a plan to the country to tackle the root cause of the issues we face, which is inflation, and a plan that protects the most vulnerable. And that's what I must do next Thursday.
So some serious expectations management there from the Chancellor, because he's really got an impossible task. He's both got to please the markets, and we know what happens when you don't, as we saw with the mini budget under Liz Truss, but he's also got to please the voters. So you can expect stealth tax rises, you can expect a freeze on government spending after the next election, and you can see less shovels going in the ground, less infrastructure spending. But that's going to have difficult consequences for growth and levelling up, which was crucial to the mandate of Boris Johnson, which Rishi Sunak is relying on.
Yes, this new government has said they want to stick with that manifesto from 2019 in terms of levelling up the country, growth outside of London. Lizzie, thank you very much. Bloomberg's Lizzie Burden with the latest on the UK. Coming up on this programme, Saudi Arabia's energy minister has just spoken to Bloomberg at the COP27 conference. We'll bring you more of that exclusive conversation ahead.
It's about recession, and what else can I quote but the IMF when they say the worst is yet to come in 23. I also see what the central bankers are saying and doing. This is a big period of diversity of uncertainties, and I have been, as well as my colleagues in OPEC, thus we've been saying our theme is being cautious, and hopefully when these good news may come our way, we will relate to them as they come.
Welcome back to Bloomberg Surveillance, the early edition. We are simulcast on both Bloomberg Radio and on Bloomberg Television. Now, if you're listening on radio, you can't see the chart that I'm going to show our TV viewers right now, but I'll walk you through it. A ton of superlatives after yesterday's massive rally in the stock market. What we've got here is a look at a basket of the most shorted stocks in the market. And we saw a jump in the value of those stocks, the likes of which we haven't seen since all the way back in March or April of 2020. As Valerie Teitel reminds us, that's when the U.S. government was pouring $2 trillion of fiscal stimulus into the economy. So does that mean what we saw yesterday was a short squeeze? Joining us now is Denitsa Tsikova, Bloomberg cross-asset reporter, to walk us through it. Denitsa?
Yeah, so heading into last week, we really saw hedge funds being quite short bonds and stocks and reducing risky bets. Obviously, when a rally like yesterday comes up, they have to unwind position and sometimes even chase gains not to be left behind. If we look at stocks, they were net bearish, and we saw the Goldman Sachs basket jump 11% on the day. As you said, one of the best performances since the start of the pandemic. So definitely there was some short covering there. If you look at other speculative corners like the ARK ETF or unprofitable tech, we also saw double gains yesterday. So definitely there was a lot of risk on sentiment. And when we turn to treasuries, hedge funds were the most negative they've been since the start of the pandemic. And especially on the shorter end, the most bearish they've been on record. Okay. And obviously we saw yields drop significantly, especially two-year yields, the biggest since 2008. So definitely there was a lot of short covering in that area. So the best question from here is whether equity exposure can be sustainably increased, or yet again we're seeing markets get ahead of themselves again.
Okay, so important question. If we broaden things, and you've already done that a little bit, Denise, talking about all of the different asset classes that were responding to the same data points yesterday, everybody in the markets was watching that CPI print out of the US, looking for any clues that we can see a downshift from the Federal Reserve. What is the level of correlation between these assets, given they were all watching the same data?
Yeah, so asset classes have never been that correlated to inflation and overall economic data, and this is a really negative correlation between them. So if we look at, for example, the stocks and then the Citi Economic Surprise Index, that negative correlation is the lowest since 2017. For bonds, this is 2019. So that means if we get a hotter print, the drops are getting bigger and bigger. But if we get a cooler print, the rallies, as we saw yesterday, are also getting more rapid. So yesterday we saw the biggest post-CPI rally on record. And going forward, of course, the Fed is very focused on that data-driven approach. Yesterday, we saw some signs of them appearing to back some downshifting rates. So there may be even more sensitivity to any economic data, from jobs data to manufacturing, but of course, inflation being the big one.
Okay, Denitsa, thanks very much for joining us. Bloomberg's Denitsa Sakova. And for more market analysis, you can check out MLIV Go on the Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. Hong Kong has slashed its economic growth forecast for this year. Authorities now see the city headed into a deeper contraction. Gross domestic product is expected to fall 3.2% in 2022. Hong Kong is struggling with rising interest rates, slowing demand, and continued fallout from China's COVID-0 policy. They previously had expected GDP to be roughly unchanged for the year. Coming up, Freddie Lait, Latitude investment founder and CIO, joins us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The rally carries over into a second day. European stocks and US futures are rising again as China adds to the euphoria triggered by falling inflation in the world's largest economy. Crypto's roller coaster ride. Bitcoin falls a day after soaring. The market's still feeling the impact, though, of FTX's downfall. And the British economy shrinks, heralding the start of what may be a protracted recession. The Bank of England sees it lasting into the middle of 2024. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kailey Leinz is off today. And Matt, as we said in the headlines, yes, another day of gains, but those gains just fading a little at the margin. And maybe that's all for the good, because we've already heard a little bit of that messaging from the Fed, the hawkish messaging coming to the fore, saying, hang on a minute, after yesterday's rally.
Maybe it's because of the GDP news out of the UK heralding the start of a recession. I love the imagery there, right? It's like cherubs trumpeting the start of a recession, on its way carrying a banner. Take a look at what's going on.
It fits with your impression of what happens here in the UK.
Exactly. That's so British. Take a look at what's going on here in terms of S&P futures. We're still up 0.5% after the amazing rally that was sustained into the close yesterday. The S&P 500 was up more than 5%. The NASDAQ was up more than 7%. These are the biggest gains that we've seen since April of 2020, when we got that massive injection of stimulus. Valerie Titel was talking about it. $2 trillion in stimulus was what it took last time to drive the markets up as high as they are in one day. And yesterday, it was just a CPI print that did that. And by the way, still 7.7% on the headline, right? Still 6.3% on the core. So still incredible inflation that has to be fought. Nonetheless, markets rallied, and maybe it was a short squeeze. I'll talk to Kriti about that in a little bit. The Bloomberg U.S. dollar index coming down. We saw the yen drop below 140 for the first time since September. That's a sign of the risk-on mood in markets. No need to hide in the greenback. You can buy stocks. You can buy oil. As a result, crude is up more than 3%, 89.40. I would say you could buy Bitcoin, but Bitcoin had such a big rally yesterday, it's giving back some of those gains, but it's still at $17,298. So the contagion from probably the most amazing story in crypto, in a decade is looks to be contained and small, at least today, right? Because we haven't seen the tokens get crushed. On the other hand, when you talk about Lehman Brothers, the dollar didn't get crushed. It was a story about the bank and not about the currency that it most often trades in. So maybe that's a little bit of the same story here. Kriti, what do you see in terms of the pre-market movers?
Well, it's interesting because you have this massive rebound, and it's a fairly broad rebound as well. But you have to talk about the China bias that's baked into the market right now, because it's not just about the CPI print or a potential short squeeze if we want to talk talk about that later, but specifically about that China reopening story. And some of the biggest movers in the pre-market right now are those companies that have that exposure. For example, Las Vegas Sands, of course, has this massive exposure to the casino operations, not just in Hong Kong, but in Macau as well, up 3.5% in the pre-market. Like I said, one of their biggest pre-market movers this morning, as well as Freeport-McMoRan, the copper maker as well, copper, I should say miner, excuse me, down up about 3.6%. Once again, really taking its cue from the commodity picture and that China reopening story. To the downside, though, like I said, a very broad rally, but there are some exceptions, and Intel is definitely one of them. Intel shares, INTC is your ticker for our radio audience, down about 2% in the pre-market. And I have to say, one of the only, I want to say, 5 or 6 stocks actually down this morning. This comes after Advanced Micro Devices unveils server chips aimed at gaining ground on Intel. We know those two companies have really been fighting for that market share, Anna, and right now Intel, at least in today's trade, losing that battle, whereas Advanced Micro Devices up about 1.2%.
Okay, chip wars to the fore there. Let's have a look at the broader European story then, Chrissy. And European equity markets, they're still positive, but losing their momentum a little bit as we go through through the third hour, as we are here in Europe of trading this Friday morning. So the Stocks Europe 600 up by 0.2%. Eurodollar, just wanted to check in on where yesterday had left us on some of these big currency pairs, or the Eurodollar specifically. 102 now the handle on the euro as it jumped on the back of that dollar weakness we saw triggered by that weaker than anticipated inflation print. And of course, that throws up the question of interest rate differentials across the Atlantic as we head towards the end of the year. Brent crude up by 3%. This not particularly to do with the US inflation story. This more to do with China. We saw that those gains in oil prices really underlined and exaggerated by the news flow coming out of China. Even if the moves are just at the margin, we knew about what they were doing with aviation. The new dynamic is around quarantine. Those rules still look tough from an international perspective, but it is at the margin, perhaps giving us a bit of a signal as to where things might go in the future, and that was enough for Brent crude to rally by 3%. This is the Richemont share price, luxury goods company, of course, based in Switzerland. This is helping many of the other luxury goods companies across Europe to rally and to gain today. Yes, there's some response to China, but there's also the numbers that we got from Richemont. They've been doing pretty well, going direct to consumer. That's part of it, but also the sheer demand that they're seeing for luxury timepieces for watches right now. Chrissy, apparently somebody buying lots of them.
A lot of green on the screen, a lot of buying across the board. At least that's part of the case that supports the equity market right now. If you have less inflation, maybe the American consumer will continue to buy, and perhaps consumers around the world. But does that mean a sustainable bull market? Let's ask our next guest here. Joining us now is Freddie Lait, Latitude Investment founder and CIO. Freddie, it's a very exciting time if you're a bull right now. But if you see, say, a 4 or 5% rally on the S&P 500, you immediately have to think that it's going to get pared back the next day. We're not quite seeing that in futures, though. So I have to ask, is the bear market over?
Good morning. No, I doubt very much the bear market's over. I think, this reaction is pretty typical for the extreme moves that we see in bear market rallies. I think, in the 2000-2003 bear market rally, the Nasdaq had something like a dozen rallies over 5-6%. So it's not a surprise. I mean, it obviously could mean the bottom of the market has been put in, but it feels much more likely that this is a bear market rally in the stocks that have just done so poorly. And if you looked at yesterday's performance, and when we did, and we correlated it to the performance year to date, it was really the year to date losers that were all ripping the most. And I think that's just indicative of a bit of short covering, a bit of sort of mean reversion, but I wouldn't think this is a change in the trend.
Well, and also you're not a top-down guy, right? I mean, in a world where all of us now are macro tourists, it's great to talk to somebody who's an actual stock picker. What do you like right now, Freddie?
Well, to start with what we don't like, I think the one thing I'd say is, the reliance on the Fed and interest rates and easy money, which I do genuinely believe is overall certainly much less of a feature for the next cycle. If you're buying stocks where their thesis or their upside rests on the Fed, other than, i.e. not fundamental reasons, I would be selling them into any of these rallies. The things we're looking at are very broad. We're buying industrial companies, we're buying retailers, we've got some healthcare stocks, we own some banks, but we also do own some technology stocks, which we think still justify their valuation, but they have to be growing underlying free cash and earnings, and they have to be inexpensive.
Well, and I look at, you have Dollar Tree. That worries me. That looks like a stock that somebody would buy going into a recession. You have AutoZone. You have Advanced Auto Parts. Ditto. Those are stocks that you buy when you think someone is less likely to buy a new car and more likely to fix her old car. So what's the story here?
The story with those ones is this is how we operate at Latitude. I bought all 3 of those stocks in the last recession. So they've all been in my portfolio since 2009. And they do benefit from recessions, but they also have this long-term structural growth behind them. So try to use opportunities like today to accumulate shares which will do well anyway, and particularly well today, and then hold them for the long term. So we've owned AutoZone and Dollar Tree. I think we bought Advance a little later, but for 13 years now. And both have compounded 15, 18, 20% a year at an earnings and free cash level, and both still trade inexpensively today. And you're right, the next couple of years are going to be very good for those businesses.
Freddie, who says that investors are too short-term these days? Freddie, I want to ask you about a long-term theme, and that is around globalization or deglobalization, because some people say, well, we might deglobalize at the margin, but really those underlying trends of going to find cheaper labor in poorer parts of the world will still stay in place. But are you investing around the opposite? And if you are, what kind of inflation assumptions should we make around a world that is less globalized? Where can inflation actually fall back down to?
There's quite a lot in that. Yes, I think if you look at sort of the effect of globalization in the last 20 years, particularly since China joined the WTO, corporate margins in the States, which used to average around 8%, have gone up to sort of 10 to 12. They've actually been coming down since globalization or trade as a percentage of GDP peaked in 2010, but they've shot back up recently. We expect that margin compression to continue for the next 5 to 10 years. As we do reshore and de-optimize, if that's a word, supply chains around the world and build in more resiliency. The efficiency was very inexpensive, but the resiliency is going to cost more. So I think margin pressure is going to come. Recreating capital stock in the developed market to replicate productive capacity in the emerging markets is also going to be expensive and inflationary to begin with. And to put a level on it, I don't know, but I do think the next cycles, what we had was sort of 1 or 2% in the previous cycle. That's now 3 to 4% in the new cycle, with wilder swings around it, is how I'd frame it.
And where do you go to find those businesses, Freddie, that withstand those trends or benefit from the trends you describe?
So investing in developed market focused businesses, I think, is more attractive at this stage in the cycle, especially the deglobalization story. And looking at industrial companies in particular. I mean, industrial production in the developed markets really not grown for the last 20 years, having previously grown with GDP. So you've got a lot of aging industrial capacity, a lot of factories that require automation, that require electronics, that require sort of 5G and Bluetooth and cloud computing to support it. So there is still that trend towards efficiency and optimization within the stock we've got here. But I think old-fashioned economy businesses, some of the energy companies, I still think will do very well. Some industrial companies basically will do very well. And also those playing into the less carbon intensive replication of this capital stock. So it doesn't have to be a windmill manufacturer. It could also be someone who can build factories that are more energy efficient, things like that. Those are the sorts of ways I'd expect to play.
Okay, a focus on factory efficiency and upgrades then. Freddie, thank you very much. Thanks for joining us. Freddie Lait of Latitude Investment. Coming up on the programme, trouble continues to multiply for crypto mogul Sam Bankman-Fried. Trouble in the Bahamas now. We'll discuss the future of the industry next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking at a live shot of the principal room. Coming up later today, an interview with European Commissioner Paolo Gentiloni. That's at 11 a.m. New York, 4 p.m. in London. This is Bloomberg.
There are very likely to be further casualties of this because crypto exchanges are interconnected. There are concentrated pockets of risk.
You have these potentially bad actors, either maybe not intentionally malicious, but they've made some mistakes in the management.
The broad crypto segment itself isn't as affected. It's more of the reputational damage that is actually sort of more the sort of call it fundamental sort of financial damage.
It is a very serious situation. There's no beating around the bush.
There were a lot of hedge funds and trading firms that actually were counterparties to FTX. So again, we may see casualties in that area.
We need to continue to fight for the regulatory clarity, the transparency, and the utility in crypto. And we believe with all of that, we will build back from this.
Those were some Bloomberg television guests weighing in on the collapse of Sam Bankman-Fried's FTX empire. More signs are emerging that FTX is crumbling. The Bahamas, where Bankman-Fried's FTX.com arm is based, has frozen the assets of its local trading subsidiary. Ana Herrera, Bloomberg senior crypto editor, joins us now for more. So, Ana, do we know now a little bit more? Have we learned over the past few days what exactly happened here? Why there's such a huge shortfall in the assets at FTX?
So we know that sort of investigators are looking at this, authorities in the U.S., and there might be some misappropriation of client funds, but it's still very murky, the picture, which raises the issue again of whether crypto is transparent or not. A lot of crypto's selling point in blockchain is it brings more transparency to finance, but we're actually seeing many of the issues that, happened in the financial crisis of 2008.
Anna, good morning. Good to speak to you. We spoke to a guest yesterday who said we should just apply regulation that we have in other sectors. We should apply that to the crypto universe, and that was the solution for him. He was saying that it's not a huge mystery as to why we don't know enough about what goes on behind these crypto operations. What are you expecting to see on regulation?
I think we'll see regulators toughening up. But again, there is regulation. It's not like it's not there. But some of these firms have chosen to incorporate in places where maybe the regulation is less stringent, like the Bahamas, right? I think maybe it's a question of enforcing more and perhaps regulators being a bit clearer in some instances about what they mean and enforcing the rules a bit more.
Anna, what is the risk here when it comes to bringing more funds back into the crypto space? It's reestablishing some of the credibility that's lost, even though, as we heard from some of our Bloomberg TV guests earlier, that systemic risk perhaps isn't necessarily there. There is reputational risk.
Yeah, there's massive reputational risk. If you're a crypto investor and have been one for many years, you're used to these big exchanges collapsing. But if you're a pension fund or an institution who's come in over the past year, you might be getting a bit wary, right? We're talking about one of the biggest companies in crypto, the most trusted, just collapsing in a matter of days. And really, I speak to sources and they're still all in shock, even people that have been around in crypto for many years. It took everyone really by surprise. And I think the impact will ripple and we'll probably see more contagion. They're the biggest, so they're everyone's counterparty. And Sam Bankman-Fried announced yesterday, too, that they were shutting down their trading house. And so, again, someone's counterparty. So we'll probably see more.
It looks like investors are able to separate the asset class, the price of Bitcoin and Ether, et cetera, from the businesses and the operators, from FTX and Sam Bankman-Fried, right? Because we haven't seen such a huge crash in the price of cryptocurrencies, even though we've seen this massive drama in terms of one of the biggest exchanges in the world. Doesn't that strike you as interesting that we don't see Bitcoin trading for 10,000, even though it looks like FTX is doomed to bankruptcy?
Yeah, it's quite interesting. We were thinking maybe it might fall even faster, and it's sort of held for now. You never know with crypto. We might finish talking and it might go down like 20%. but
not anymore,
we'll
right? We don't see those huge swings. We haven't for months.
Yeah. I don't want to jinx us, going back to my desk after. But obviously, we'll see what institutions do because those have been the big entrants in the space, and let's see if they are now bearish on crypto exchanges versus crypto as an asset class. I think that will be the next big thing to watch.
All right. Anna, thanks so much for joining us. Hope to continue talking to you about crypto. Ana Herrera is a senior editor for Bloomberg Crypto out of London. Tune in, by the way, to our program, Bloomberg Crypto. That's every Tuesday at 1 p.m. New York time, at 6 p.m. in London. Our weekly show that covers the people, transactions, and technology shaping the world of decentralized finance. And of course, right now, we are almost completely focused on one man, on one company, on FTX. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta alongside Matt Miller in New York and Anna Edwards in London. Kailey Leinz is off. Let's take a look at what's going on ahead today. After yesterday's surprise CPI reading, investors will now be focusing on the University of Michigan Consumer Sentiment reading due at 10 a.m. Eastern. And the counting in the midterms continues today, with the struggle for control of the Senate boiled down to just 3 races: Nevada, Arizona, and Georgia, all in the hot seat. Meanwhile, Republicans are inching closer to gaining the majority in the House. And President Biden is at COP27 in Egypt, where later today he's expected to further outline his administration's commitments to emissions reduction and green energy. Now, Anna, it's interesting. We've been talking about midterms and inflation so much. It feels like the COP27 narrative hasn't been necessarily priced into the market, even though you're seeing some of these EV stocks, green stocks, actually kind of make a little bit of a statement on perhaps the future of some of President Biden's policies.
Right, and let's stick with energy themes. Saudi Arabia's energy minister spoke exclusively to Bloomberg at the COP27. Let's listen to what he had to say.
Carbon sequestration is very fundamental because we also have uses for it as a way to enhance oil recovery.
One question, if you permit me, sir, on the oil market. You decided to cut production at the last meeting. We've heard the news this morning that China is starting to open up its society again, lift COVID restrictions. We have an acute shortage of diesel in some parts of the world. Is there a risk that the market is getting too tight? And will you look again at production levels in December?
I haven't heard that news, but I was just checking this early this hour of the morning. Actually, I saw the different thing in Bloomberg, which says that China is closing more cities and what have you. So the jury is still out. I do take what the Chinese authority are saying, and that they are saying is that they are going to continue to be strict and diligent and follow the same regimentation that they had. But it's not just about China. It's about recession, and what else can I quote but the IMF when they say the worst is yet to come in 23. I also see what the central bankers are saying and doing. This is a big period of diversity of uncertainties, and I have been, as well as my colleagues in OPEC, thus we've been saying our theme is being cautious, and hopefully when these good news may come our way, we will relate to them as they come.
So it's always about being flexible?
It's about being responsible and not to lose sight of what the market requires, the industry requires, which is sustainable stability of the markets.
Saudi Energy Minister just speaking exclusively to Bloomberg's Will Kennedy at the COP27 conference in Egypt. And Chrissy, interesting to see that, it's too early for OPEC to say whether the China news is material about any change in COVID policy, of course, but the market has jumped on that to some extent. The Brent price, as we head towards the start of US trade, up by 3% this morning.
It really has, and I think the other point you still have to make, though, is that even as you have this kind of unquenchable demand almost for oil, and I would say commodities across the board, some of these EV stocks are still actually higher. The idea that this energy transition conversation, it's not over, Matt, even if you do have Republicans perhaps gaining a little bit more of an edge in Congress.
Yeah, to me, my hope for COP27 is that they find a way to deal with all the trash that rich countries like yours, Anna, in the UK, or ours here in the US, are constantly shipping to Thailand and Malaysia and Indonesia and just polluting the earth in a disgusting way. Matthew Campbell, a Bloomberg journalist, has an incredible story on The Big Take. I wish everyone would go there and read an NI Big Take about this problem.
I will dig it out for weekend reading. We might need another conference on that subject. That's it for Early Edition. Surveillance is ahead. Tom, John and Lisa standing by to take you through the market moves. This is Bloomberg.